Good afternoon, everyone. Welcome to the webinar sponsored by Santomassimo Davis and Outside General Counsel Solutions. I'm Chris Santomassimo, one of the partners at the firm, and we're here to talk about the Payroll Protection Act loans under the CARES Act. And if time permits, at the end of our presentation about the CARES Act, we're going to cover some HR issues that are front of mind thanks to what's going on with the COVID-19 crisis and also under the Families First Act. I want to thank everyone for attending today. We are, in the course of our work as outside general counsel for clients, there's 15 lawyers at the firm, and so we're seeing a lot of different clients and dealing with a lot of different unique issues. What we tried to do is, round up a collection of the issues that we're seeing with our clients, things that are front of mind with the folks that we're speaking to every single day, and to share that information with all of you. One thing sort of hit me through the course of this crisis. We talk a lot about social distancing and maintaining our distance or a safe distance from others. I kind of would like to think about that more as physical distancing, because the social interaction that we're having today, at least by webinar, is hopefully going to allow us to share information not only among the folks on the call, but also with people that you do business with and come into contact with. A couple of housekeeping items. Again, we'll hit the CARES Act first. Secondly, we'll hit some of the HR issues. To the extent that you have any questions, I'd like you to use the chat function in Zoom. Throw those up on there and we'll see them, and then we'll answer as many as we can during the session today. We're going to hold the questions until the end of this session about the CARES Act, because I'm pretty sure that many of the questions that might come to mind for you folks may be covered in the material. And then I'd also invite you to contact us after the call, free of charge. We're going to help as many folks as we can and provide as many answers as we can. At the end of the session, you'll see all of our email addresses, and I would invite anyone to reach out with questions and concerns that you have. And we'll be happy again to answer as many of those as we can. So without further ado, I'd like to introduce my partners, Anthony Davis and Alex Anglum, who are going to lead the discussion about the Payroll Protection Act loans under the CARES Act.
There we go. Hey everybody, good afternoon. I think there's been a lot of news about this payroll protection program. It's historic, it's evolving, and even since we finished our earlier discussion today at 1:30, the SBA has now posted on its website and I'm looking right at the Paycheck Protection Program application form is up and live. That was not, we've been checking several times a day since Friday, and that is now up for you to use. It is a sample form. Don't know if it's the final form, but I scanned it quickly before the seminar, and it tracks pretty much what we've been advising clients, what we learned from reading the Act. But we appreciate everyone jumping on today. Our title kind of tried to say it all, right? The CARES Act. Who's eligible, how much can you get, and how do you make sure the loan's forgiven, and what's going on with this thing. So these times we're in, the focus has really been on personal safety and health, family, friends, employees, colleagues, and as business leaders, a lot is depending on us to lead, frankly, and get through this crisis. And the point of us spending the last few days looking at this and understanding it, and now putting out the word in this webinar is really part of that, is to help our clients and leaders of businesses act on this and keep their businesses running and lead. So the major piece of this new CARES Act is the Paycheck Protection Program. And it's really a program to get loans out quickly. Money is supposed to be spent over an 8-week period after the loan is originated, when you receive the money. And it's to be used to keep your businesses going, to pay the basics. And we're going to go over the details. So what have we done at our firm? Well, since Friday morning, we started analyzing this before it was signed into law. And then we spent the weekend reading it, studying it, evaluating it, talking to clients about it. And as their questions kept coming up, the same questions over and over, we decided to do this webinar to get the word out. And I think at our earlier one today, there was over 100 business leaders on the call. So we're really, really happy to see that. And right now there's another 43 on this call. So this is great. We are recording it. So hopefully if we need to replay it, we can do that if anyone's interested in that or knows someone who missed it and would like to hear about it. We have a lot to cover. And so we're going to keep it moving. And our focus on in this, as Chris said, is the Paycheck Protection Program loans. There's a lot in the CARES Act for, the $2 trillion that are being given away, but the $350 billion is the key piece that we're going to talk about today. There's a lot of money for certain industries and for local governments, but we're focused on small and medium-sized businesses. And there's 3 new stimulus programs that provide immediate relief. And the one is the loan program. Some of you may have been receiving some guidance from your lenders or your banks already. We've seen a few today where banks are getting ahead of it, saying, here's the checklist of things we're likely to need. And the SBA website now for the first time says that banks can start lending on April 3rd. So will they? We don't know, but that's what's officially stated on the SBA website. The one thing I'll point out, and we've said it in a few webinars we did last week on the first few pieces of the coronavirus legislation, is please, everyone, remind your entire team and your organization, your people at your home, your family members, keep your guards up. The FBI is reporting, unfortunately, just like in all crises like this, increased levels of scammers, people trying to steal people's money, their information. So obviously, keep your personal information protected. Do your research before you click on any link, especially if your charities trying to gather money through social media or crowdfunding or purchasing products online. Don't give up your personal information to receive money or other benefits. And this program, with $350 billion being given out, we're already anticipating that there's going to be a lot of people trying to get their hand in your money or do something nefarious, and the FBI is giving a lot of loud warnings about that. So look out for fake CDC emails in particular they're warning about, obviously phishing emails. Those are the 2 big ones, but that's just a reminder. I know everyone's careful with cybersecurity and risks, but now we're all working remotely, doing everything electronic. There's going to be a lot of money flowing. Just be really careful. Next slide, please, Chris.
All right. As Tony alluded to a minute ago, there are 3 main stimulus provisions that we're concerned about in this program that are all part of the CARES Act. Very large piece of legislation, but it has, in addition to many, many other things that are in it, has 3 new stimulus programs that we want to focus on today that are sort of, I guess you would say, they're of broad interest to virtually all small and medium-sized businesses. They may not take advantage of all of them, but they need to at least be aware and decide what they're going to do. The first one of those is the Paycheck Protection Loans with Forgiveness. That's under sections 1101, 1102, and 1106 of the Act. And that has been the one that has gotten the most press so far. It has the largest amount of money allocated to it, about $350 billion, which is particularly going to be particularly attractive, we think, to most businesses. The second one is an employee retention credit, which is not to be minimized. There could be some businesses where it might be more beneficial to them to go with the employee retention credit rather than the paycheck protection loans. That'll require a little bit of analysis, and that analysis will be assisted by some of the material that we give you today in the program. Important point, and I'll emphasize this again later, that the paycheck protection loans and the employee retention credit are an either or scenario. You cannot take advantage of both. You can only elect one of those two. And then the third major stimulus provision that we're going to highlight today are subsidies and payment deferments for existing SBA loans. That means for any business which is currently a borrower under an SBA loan, either a direct loan or an SBA guaranteed loan, they will have some important benefits that we're going to talk about later. Those can be coupled with one of the other two programs we mentioned first. What's the upshot of these three? The upshot is that each of these and collectively it provide potentially very large financial benefit to employers that are affected by the virus. And as we'll see, that's really meant to include almost all employers. It's not a very narrow focus for any of these programs. It really is, they're broadly focused, not to any particular industry, and there really are minimal thresholds to get involved with them. So having said that, with this next slide here, we just want to pause for a moment and give you we'll have a way of explaining the current model by differentiating it from the ghosts of stimulus past. Back in 2009, the Obama administration passed the Stimulus Act that in most of the discussion, most of the lead up, and a lot of the news coverage had the phrase shovel-ready projects, and that was really meant to evoke this idea that the money would be put to use very, very quickly, would help stimulate the economy very, very quickly. But those shovel-ready projects really were construction projects that had some advanced stage of approval, but were still going through a government procurement process. This really didn't, it really held back the economic effect of the stimulus. And by 2011, President Obama said, really candidly, that they had overestimated the shovel readiness of the projects. And I think you see that reflected in the current stimulus now. It's a totally different approach, right? In 2020 now, the stimulus program that we have involves direct payments, right, to employers that are across all industries rather than a government procurement process that's focused on specific industries like construction. And this program is going to be administered by banks. So instead of going through a government procurement process, the paycheck protection loan in particular, the money is going to be sent directly out the door, and the paperwork and administration is going to be handled by banks. And as Tony pointed out a minute ago, that administration is getting up to speed very, very quickly, and hopefully is going to be much, much faster than anything that anybody's experienced in the past under the general heading of stimulus programs. Next slide. We also want to point out that some of the program names, some of the different SBA loans, disaster programs, stimulus programs, the names can become a little bit confusing. There is a program known as the Economic Injury Disaster Loan. That's an SBA loan program. It may be applicable to your situation now, but that is not a new program. It's been around for a long time. Those are low interest loans that have to be paid back. And there are some changes to that program in the CARES Act. And some of those changes may be important to you. But that is not the focus of this webinar. And it is mainly because we're focused here on the programs that provide some really new economic value, really subsidized, heavily subsidized economic value to employers. Whereas the Economic Injury Disaster Loan, as I said, these are working capital loans that need to be paid back. So with that, I'll turn it over to Tony to start talking about the Paycheck Protection Loan and how that can benefit you.
Okay. So in the slides now and the things we're going to talk about, we have analyzed the act in this part of it, the Paycheck Protection Program loans. We're giving you this information so you can understand the framework of it without having to read the hundreds of pages and do some legal analysis. We want to give you a framework of analysis to understand what it's meant for, what it's supposed to do, so you can understand when you're applying and when you receive the loan, how to spend it to make sure it's forgiven as much as possible. All right. So the loans under the Act are to be used for limited purposes. It's to retain employees and continue operations. The key things that are to be paid are payroll costs, rent, health insurance premiums, mortgage interest on secured debt, utilities, and the money has to be spent over 8 weeks after you receive the loan origination date. That's key. The title of the section in the Act that provides the PPP, the Paycheck Protection Program, is titled Keep American Workers Employed and Paid. Keep that in mind when you're going through this process and using the money. Don't reduce your headcount or reduce salary or compensation unless you understand how that may affect your ability to get this loan forgiven. You can do that if you have to, but understand and follow through on the analysis. So when you go to see forgiveness after the end of June, you don't get reduction because of headcount changes or reductions in salary and compensation. And we'll go over some of those details. Up to 100% of this loan can be forgiven. That is the key to this, that it's supposed to be easy to obtain in an amount not to exceed $10 million for a company. We'll go over the details of how to calculate it, but its purpose is to be forgiven if it's spent on the right categories in the 8 weeks after you receive the money. The statute is written to broadly cover all small and medium businesses. There's no requirement in the Act that says you have to be an essential business. You have to be in a certain category of business. It's all businesses of any kind. As long as you're registered and created under the laws of the states, one of the states, and the employees that are being paid they're here in the United States being paid. You do not need to be on the brink of insolvency. There's no requirements in the Act that say you have to exhaust all of your money or tap out your credit lines or spend all your money on reserve. There's no rules that say you have to have certain revenues or be of certain size. It's for all businesses. So here's some of the key elements for eligibility. Fewer than 500 employees. Fewer than 500 employees. Now there's an exception for that if you have multiple locations like franchises or hotels or restaurants. If each location has under 500, then they'll be eligible on a location by location basis. You had to be in operation on February 15th of 2020. So if you're just starting a business tomorrow, not eligible, right? At the time, as of February 15th, you had to have employees or independent contractors who were being paid by the borrower, by the business applying. The Act, one of the key requirements in the Act for obtaining this loan is providing a certification made in good faith. And I can see that just having scanned the sample form that they're asking people to make certain representations about the uncertainty of current economic conditions makes the loan request necessary to support the ongoing operations of your company. For these loans to be processed quickly, the banks are going to be able to rely on representations of business owners and the documents they submit to get these loans. It's going to happen very quickly without the typical due diligence and vetting that is ordinarily seen in commercial lending. Next slide, please. All right. Again, what is not required? I mentioned it before. No need to exhaust all your other credit or prove you can't get loans from other sources. No personal guarantee is required. No collateral, no security. The fees are waived. And importantly, there's no federal tax on the amount forgiven. So, typically the IRS says we're forgiving if the banks forgive a loan, then you treat that as income, not in this case, specifically accepted under the statute. Go ahead, Chris, next page, and let me turn it back to Alex.
Yeah, thanks. This is one of the more important subjects, obviously, is what's the borrowing capacity? How much money can your business obtain? And then how much of that will be forgiven? The first is that your borrowing capacity is going to be defined by your payroll cost. You're going to have 2.5 times your average monthly payroll cost. Now, for the most part, there are a couple of wrinkles here because payroll cost is defined in the statute itself, and it's more than a couple of words long. But in general, what you're going to be looking at here is that the payroll costs, your payroll figures are going to be averaged, and you're going to use that as a baseline. And Tony will talk a little bit more about that baseline in a minute. Within that, there's going to be another wrinkle for employees who are paid at a rate that is higher than $100,000 per year. And it's important to talk about that as a rate, right? It's not $100,000 during a specific period like the 8 weeks. It's $100,000 per year. That's going to be a maximum that will be factored into this analysis. On the back end, defining how much will be forgiven, the overall setup of the program is that 100%, all of the money will be forgiven if it's used within 8 weeks in a specific way. And that specific way is to pay the expenses that are listed in the statute itself. Payroll costs, rent or mortgage debt, utilities, okay? Those are the categories that are in the statute. If you spend it all in 8 weeks on the approved categories, then it's going to be forgiven, right? There is an analysis that has to take place, though, to make sure that your forgiveness is not reduced. There's going to be a cutback in the amount of debt that is forgiven if you either reduce the number of employees that you have or reduce the pay of those employees. And then still again, you can prevent that from taking a bite out of your forgiveness if you bring those numbers back up by June 30th. So overall, the overall thrust of it is that if you keep your head count steady and you keep paying your people at about the same rate, you're probably going to have all the money forgiven. You spend it all within 8 weeks. If you don't keep your head count steady, then you may need to pay close attention to that. You're either going to have to bring the head count back up by the end of June, or bring the pay scale back up if that's the reason for the cutback, again, by the end of June. And that's the overall approach. We've had a lot of questions, pretty specific details. What is this going to be covered? What is that going to be covered? I think we've had an overall approach of just thinking, look at the way this is written. If you go ahead and you use the money the way it's intended, you're going to be in pretty good shape. I think that's the overall message, and there are some details, but that's the overall message. Next slide. And Tony, are you going to take the pay periods?
Yeah, sure. I would echo what Alex was just saying, is that over the weekend and yesterday, we had a lot of detail questions from clients about expenses are forgivable. We thought that if you get 2.5 times, and I'll go into details now from the statute about some of these things, but if you get 2.5 times your average monthly payroll and you spend that over an 8-week period, so if you receive that money in the second half of April and you pay your May 1 and June 1 business expenses and pay payroll for 8 weeks, our estimate is you won't need to drill down and trying to expand these definitions or get fancy. It should burn through this money, and for the most part, you should achieve 100% forgiveness on the loan. If you don't have it all forgiven, then the guidance that I see up on the SBA website now says that the loan has a 2-year maturity and an interest rate of it says 0.5. I think they meant 5%. The statute says 4%, but I can't believe the interest rate is half a point. But anyway, I tell you that this is an evolving issue. But let me go into this a little bit in detail here. So the key for determining your payroll costs, and maybe bring up the next slide, Chris. Yeah. So what you're seeing here is the first part of a guideline issued over the weekend by the U.S. Chamber of Commerce. And we reviewed this extensively against the statute and the act and the Paycheck Protection Program. And we found it to be very, very authoritative, very accurate in terms of how you determine your payroll costs, what's included, what's excluded, how much of your loan will be forgiven, and what your sort of next steps are. So we're displaying it here. We'll also make it available just like we will with this whole presentation deck. So anybody needs it, they can use it. But let's go to the next page and I'll go over what the key to this. So you can see here, the definition in the Act says payroll cost. So the key is looking back 1 year from the date you make your loan application. Those are two of the key timeframes. It's 1 year back from the date you apply to determine your average monthly payroll cost. And the other key time frame is 8 weeks from origination, 8 weeks after you receive the loan money. All right. So as you can see, to come up with your payroll cost, it's the sum of salaries, wages, commission, similar compensation, payments of cash tip or equivalent, payment for vacations, parental, family, medical, or sick leave, allowance for dismissal or separation pay, payment required for the provision of group health care benefits, including insurance premiums, payment of any retirement benefits, payment of state or local taxes assessed on compensation of the employee. Again, when you look at that through the lens and the goal of the statute, which is to keep Americans paid and employed, this is the core of it, the payroll. So all the words that they're using here in this guide are right out of the statute. And our assessment is that you should give everything their plain meaning. Like, don't try and get too creative or fancy with this. The words are the words. It's your payroll. And it also includes, there's provisions for sole proprietors, independent contractors, self-employed individuals. There's not a lot of guidance on that yet. We're expecting from the Treasury and the SBA some guidance about how that is going to work in terms of calculating your payroll cost when you're self-employed. I think it's going to come down to just having your tax returns and Schedule Cs to show what kind of money you were taking home from your business. And they're going to make it have a pretty simple formula for getting money to those small businesses too. What's excluded from payroll cost? Compensation of an individual employee in excess of an annual salary of $100,000. All right. So that means you can include in your payroll cost every employee that makes over 100,000, but only that amount. Okay. This is to calculate the loan amount that's eligible under this. Few other items: payroll taxes, railroad retirement taxes, income taxes, any compensation of an employee whose principal place of residence is outside the United States. Last item: qualified sick leave wages for which a credit is allowed under the FFCRA. And that's the new program that was instituted last week, I believe. So those payments are also excluded from coming up with this amount. So you look back over the year, divide it by 12, and you come up with an average monthly amount, multiply it by 2.5, that's your loan amount. All right. The other side, then from the date you receive those funds, you have to spend those on certain expenses that will qualify for forgivable expenses and forgiveness of the loan. And I have a copy of this part of the statute here I want to read and make sure everyone understands it. It states that the eligible recipient shall be eligible for forgiveness of the indebtedness of a loan in an amount equal to the sum of the following costs incurred and payments made during the covered period. I'll read the part that's key again. Costs incurred and payments made during the covered period. We're reading that to mean that following expenses, you have to incur them during the 8 weeks. So we're advising against deferring payments unless there's payments you just need to make to keep your business afloat. But don't sit on your April 1 payments, and then when you get your loan at the end of April, pay things that were incurred in the beginning of April. The bills came in and they're due. I think the plain reading of the statute is you're going to pay the bills as they're incurred. You get the money in April, your May 1 bill for various things, rent, health insurance premiums, utilities. That's what's going to be qualified under this language of the statute. So let me just go through now the things that can be forgiven. So payroll costs, using the same definition to calculate the loan amount. Interest on mortgage obligations incurred in the ordinary course of business by the borrower, the business, that was before February 15th of 2020, and for which there is some security, whether it's real property or personal property. The statute's very clear. It says it has to be a secured loan, and it pays the interest, not the principal, just the interest. Rent obligations, so monthly rent payments. Again, it has to be from an existing lease obligation that existed before February 15th. And utility payments. And for utility payments, that means electricity, gas, water, transportation, telephone, or internet. Now, one of the questions we had was, well, what does transportation mean? There's no definition in the Act what that means, so give it the ordinary meaning. If you have trucks that you use to transport your goods, those are kind of the simple ones. If you have transportation for your employees to get to and from work, that might be covered too. Again, I think it's a small piece of this, but that's the part of the analysis where we think it's probably not helpful to go too far down the rabbit hole trying to figure it out, when the bigger piece of this is to get payroll covered, not so much to worry about getting transportation costs covered. And I do note that, and again, I'm looking at the SBA posting today, and we haven't even had a chance to talk about this internally, but it says in the forgiveness section that at least 75% of the forgiven amount must have been used for payroll. And before we jumped on the call today, I searched the statute for 75%, some qualification on payroll. I don't see it. I didn't see it when I read it. But this is in the SBA's guidance. And again, this shouldn't be that big of an issue because the goal of the statute is to have the money used for payroll. But I'm pointing that out because it's on the official website of the SBA. This is, again, the first pronouncement in the last few hours about this. But it says 75% of the forgiven amount must have been used for payroll. There's no citation. It just says, due to the likely high subscription, meaning everyone's going to take this loan, there's that limitation. So if we can get any further clarification on that, we'll find it. But even if the statute doesn't say it, if that's how they're running the program, we're going to be bound by it. So importantly, when you get to the point where now you've obtained your loan from your bank, again, it's going to be helpful to get ahead of this process. We'll talk about some of the action items in a few minutes to get ahead of this curve. You calculate the amount. you get the money, you spend it over 8 weeks. That puts us sometime into June, and then there's going to be a forgiveness application process. And the thing to look out for is not only spending it during the 8 weeks on these specific forgivable expenses, again, payroll costs, interest on mortgage, rent, utilities, but also you could be subject to reduction in what's forgivable. And the two buckets or categories you have to look out for is reduction in number of employees or a overall reduction in salaries and wages in an amount greater than 25% at the time you seek the forgiveness when compared to the most recent full quarter before that. All right. There's a lot of timing and notes. That's why I think this U.S. Chamber of Commerce guideline, it has all the dates, it has the details of how to calculate these things. But you really have to keep, this adds a calculation to, do you bring people back? What do you do? Well, depends on people's pay rates in terms of layoffs, but that headcount issue can be significant, right? Because if you had last year and it's from February 15, 2019 to June 30th of 2019, you look at that period, or January 1 of this year through February 29th of this year, take that period, and that's the bottom of the fraction. The top is what you have during the 8 weeks beginning on loan origination. So if last year, the beginning of this year, you had 20 people, and during the 8-week period, you had 10 divided by 20 is 50%, you'd have a 50% loan forgiveness reduction. All right. Again, I'm just giving you broad strokes, but the idea of the statute is to keep workers employed and paid. And you can bring people back. It's within 30 days of the enactment of the statute. And that was last Friday. So there's 30 days. You've got time to make some decisions and get your head count up. And if you read through this guideline, it'll help you. We can also offer assistance. This is the one area we've found with most clients that everyone's a little different. Everyone's responded in a little different way. Everyone's got a different group of employees at different pay rates. So there's some math and some science to getting this done right, getting the loan forgiven. And just remember, if it's not forgiven in full, then it's a low interest loan, or if you have the cash, which would be great, you could just simply pay back what's not forgiven. Either way, it's a great program and should be applied for. Let's just go to the next slide, Chris.
All right. As we said at the beginning, there are really three main stimulus programs that are in the CARES Act. We do expect the Paycheck Protection Loan is going to be the most attractive of them to most businesses, but it's important to know what the other two are as well. And it's particularly important to know this one, the Employee Retention Credit we're about to talk about, because as I said before, this is an either-or program. You cannot have a Paycheck Protection Loan and an Employee Retention Credit. You have to choose which of these you're going to take advantage of. So let's start with the eligibility. Whereas the Paycheck Protection Loan starts with a good faith certification that we highlighted earlier, which is fairly fuzzy, basically says you have to certify in good faith that you, in light of the uncertainty, the loan's needed to support the operation of the business. The Employee Retention Credit is a little bit more rigorous in how it defines who is going to be eligible. You have to either completely or partially suspend operations as a result of the crisis, or show that your quarterly revenues have dropped by more than 50%. If you fall into those categories, then you can potentially take advantage of the Employee Retention Credit. The next difference is the time limitation. Whereas all of the money on the Paycheck Protection Loan needs to be spent within an 8-week period in order to be forgivable, the Employee Retention Credit is not time limited in that way. It is limited in value to $5,000 per employee, and it does end when your quarterly revenues recover to 80% of what your baseline is. But potentially, it could apply for longer than 8 weeks, and that may be something that, based on your particular scenario, again, may be a reason that you lean towards this program instead of the Paycheck Protection loan. And then this last piece here is important because it gives you a dividing line between businesses that are eligible and businesses that are under 100 employees, which have a little stronger form of the program. If you've got more than 100 employees, the tax credit is only going to apply to employees who are not working. And it's important to point out that the statute says employees who are not performing services for the employer. So that means if you have employees who are not doing their regular job, but you've redeployed them to do something productive while you're shut down, perfectly reasonable thing to do, a good business decision, but those employees would not be eligible for the credit. So even though they're not doing their regular job, they're performing some services for the company. If you've got more than 100 employees, those folks are not going to count. If you've got under 100 employees, then they don't need to be totally idle. So that's, again, it's an important point to keep in mind if you're trying to determine, whether this is going to be better for you than the Paycheck Protection loan. I was sort of ruminating earlier about what type of employer might want to take advantage of the employee retention credit. I could envision, maybe something like a cleaning service, doesn't have a large rent obligation, which is one of the major things that are payable under the Paycheck Protection Act. It has a lot of labor costs, but most of the employees are at a fairly low, relatively low rate of pay, maybe $15 per hour or something. When you run that math through, you might find a bigger benefit under the employee retention credit for that reason. So again, you're going to have to do a little bit of math in order to figure out what's better for you, because you cannot take advantage of this and the other program as well. Overall, best guess is that many more businesses are going to find the Paycheck Protection loans to be more advantageous to their situation. But again, it's going to be case by case. All right, next slide. And the third program we want to highlight today that's in the CARES Act deals with companies that have existing SBA loans. So this is going to be of interest to you if you're already a borrower under an SBA loan, whether it's a direct loan or an SBA guaranteed loan. The first aspect is that automatically, without any eligibility criteria or any other requirements, the government is going to pay 6 months of principal and interest payments on your existing loan. And just to avoid any ambiguity at all on this issue, the CARES Act specifically says that reduces the indebtedness of the borrower. So it's not just a payment holiday. The government's actually paying down your loan according to whatever your current regular monthly payment is for 6 months. We read the act, and there is nothing in there about a request. It does seem to be automatic. We've also heard from other sources that it's intended to be automatic. It's supposed to happen right away. Nevertheless, there are a lot of different institutions involved, so it may make sense for you to reach out directly to your lender or whoever's servicing your loan and send a letter that says, you're expecting this benefit, to just confirm rather than, just start skipping payments. But again, there doesn't seem to be any kind of application or an eligibility, so very good benefit. The second benefit for existing SBA borrowers are deferments. And we've quoted here on the materials this sense of Congress provision, which we thought was important, and I think we found out is we were right about that. The way the act is written is it says it is the sense of Congress that all borrowers are adversely affected by COVID-19, And it also says the SBA should encourage lenders to provide payment deferments when appropriate and to extend the maturity of covered loans. There are a number of provisions that follow after that, just to make sure that lenders will have the legal authority to do that based on the particular loan program that you might have borrowed under. So our view upon reading this over the weekend was that deferments are going to be liberally granted, maybe just for asking, 6 months, perhaps longer. We've since heard some information where we're told now it's going to be virtually automatic. Again, we think there probably should be some follow-up on that, but if you have an existing loan with the SBA, whether it's a 7A loan or another similar loan program, you should be getting, number one, a deferment, and number two, 6 months of principal and interest. It is clear from the statute that you can get both of these benefits together or really in succession. And in fact, if your loan is already on a deferment status, the principal and interest payments by the government are supposed to kick in with the next payment that's due after your deferment expires. So again, two pretty significant benefits for existing SBA borrowers. And we probably would just recommend that you follow up, make sure with your lender that these details are taken care of, but it does not sound like you're going to have to do much of anything in order to get that accomplished. All right, next slide. Back to Tony.
So, and we do see the questions coming in. We're gonna take them right when we're done. Practical points, all three programs. So again, as I noted, the sample form now is up in the last hour or two, but it says right on it, sample. So the forms and the process remain to be developed. I believe the banks and the SBA will work hand in hand to get that streamlined process done. And the banks are playing catch up. We've spoken to our contacts at various banks that we work with, and they're having their own internal team meetings trying to figure out how they're going to meet this demand. But they're going to do it. They'll figure it out. And I think once everyone understands that it's the intention and what's supposed to happen here, I think these loan applications are going to get processed quickly. Money's going to hit accounts, and that's the directive from the top. That's what the Secretary of the Treasurer said in the last few interviews that he gave publicly, that he wants this happening by Friday. And I think everyone's trying to get it done. Banks are expecting a high volume. And so with that, we would suggest that you see who your bank is right now. And you can check online or contact your relationship person and find out if they're an SBA lender. You want to be banking with an SBA lender because those are the ones that are approved to do these loans. It's pretty easy to search online and find the list of approved lenders in every state. There's a lot of banks that do it, but if you are with us, maybe a small bank that does no SBA lending, our advice is, as a practical point, is to go over to one of the banks that are approved, open an account. You may have to move your banking relationship, but at least become a banking customer, get in their system so that this can be processed. Don't wait to open a banking relationship in 2-3 weeks when they're starting to process and you're at the end of the line. Next slide, please. So these are some of the things that we've thought of and recommend as a call to action. So get legal advice now regarding which program your company is eligible for. As you can see, there's some moving parts and some math and science to calculating what's best for your business. A lot of you will have challenges with people having left, people being out sick currently, people not reporting for duty. This is where you need to get the advice to make sure, especially for sizable business where you're going to have hundreds of thousands of dollars in potentially forgivable loans, you want to make sure you get this done right. Incorporate all of that advice into your business decision making regarding any proposed layoffs, shutdowns, resuming operation. rehiring people, and you can do that. You can rehire people, you can replace people. It doesn't have to be the same people that were working for you. It's all headcount. And there may be some negotiating with your existing lenders, creditors, landlords. At the moment, last week we were telling people, talk to lenders and landlords about negotiating, deferment. Well, under the statute, it has to be costs that are incurred and payments made during the covered period. So if you have an agreement with your landlord to not pay rent for 3 months, 6 months, that rent's not incurred. So it's not going to be forgivable. So for the moment, we would be telling people don't sign deferment agreements. If you've got a loan that you're paying interest and principal on, and it's a secured debt of the business, it's going to be forgiven. Your rent's going to be forgiven, at least for the next two, the May 1, June 1 periods. This is to get through, it's an 8-week period. You can revisit it at the end of June, in July, with your landlords and lenders. I've already talked about having an account open with a bank that's an SBA lender for priority. Well, we were saying this until this seminar, but I was saying use the existing SBA loan applications and forms, not to apply, be clear about that, not to apply, but as a guidepost to sort of print those out, start filling in blanks and gathering data. You could still do that. They're a little more comprehensive than this form that's up now, the sample Paycheck Protection Program application. It wouldn't hurt to have that in your hands. The SBA has a history of lending and getting their loan application. They may supplement it and say, yeah, we want the standard form filled out if they need it, and the program's not open yet. Take an hour or two, this week to fill it out. Start assembling all of your documents. And assembling all these documents to prove your payroll costs. That's what's going to be important. So I can just see from the sample form, it's payroll cost times 2.5 loan amount, and then you just need the backup. How did you come up with that number? And I think that's where this guidance will be helpful from the U.S. Chamber of Commerce guidelines. And as you drill into this, you're certainly going to have questions about it. And it's all brand new. So there's no case law out there. There's no, guidance books. It's reading it. And that's why I'm encouraging everyone, give things the plain reading and the purpose of the statute to keep people paid and employed. And that'll guide you well, I think, through your decision making. That's kind of the end of our presentation on this aspect of it. I think our next slide, Chris, back to you, is personnel issues.
Yeah, what I'd like to suggest, guys, is there's a lot of great questions on the chat, which I think are important to get to. So let's hit, and they relate to the material that you guys have talked about. So let's hit those first.
Sure.
Sure. There were a couple questions from people about independent contractors, sole proprietorships, with some details there. We could crunch those together into a single question, which is that under the Act, you're supposed to be eligible, right? All forms of businesses are eligible, right down to the smallest type. The documentation requirements, though, are going to be a little bit ambiguous right now. Those will probably get firmed up as these forms come out and as there's more guidance from the SBA as they develop the forms. Business owners are going to be subject to the $100,000 per year salary rate limitation that we have elsewhere. And I think that is highlighted on the form that Tony was referring to earlier, the Chamber of Commerce form. So that was one of the ones that I saw.
One issue that I'd like to make sure everybody understands is this is supposed to apply to U.S. businesses. That is, U.S. companies that are operating here in the United States. So, and this is one of the questions on the chat that came up. If you're owned by a larger global parent, that doesn't really matter, even if you're wholly owned by a foreign company. It's U.S. companies, U.S. employees. So if your U.S. subsidiary has fewer than 500 employees, but on a global level, your company's got more than 500, it doesn't matter. It just matters what's present in the United States. And similarly, the global parents' payroll doesn't come into account at all for purposes of this incentive program.
Yeah, exactly. And I see on here a question. I had 2 employees leave for another job in the past 2 months. I did not reduce them. Is this going to affect my head count? Good question. The statute doesn't say anything about why they left or who reduced them. It's a straight math equation. So number of employees you had during the 8-week period divided by the number that you had the beginning of last year or the beginning of this year. So again, the point is if 2 people left, you should replace them so that you don't get reduced on that, right? If you had 10 employees and you lost 20% of your workforce, you would get a 20% reduction. Okay. Also, do independent contractors count as employees? The answer is yes, they do. If anyone you're paying through your business using payroll, independent contractors, commissioned salespeople, they're getting wages. The cap is 100,000 for the calculation and as an annualized basis, but yes, they count. It's, keep in mind, they want all American workers to be paid and employed. So if you've got a whole slew of independent contractors working for you, you can borrow this money, keep paying your independent contractors, and it will be forgiven.
Right. Somebody asked a question too about employees who are not working currently. I think what you're saying is maybe what Tony was covering, which is if somebody's been laid off already or unemployed, as long as they're brought back onto the payroll by June 30th, then they can be counted as retained.
Oh, there was a, thanks for reminding me, Chris. I saw a question, I tried to scroll back to it. There was a question earlier, I believe, that related to the employee retention credit. If they're idle, how can you be paying them? If that wasn't clear, I'll clarify it this way. Under the employee retention credit, if you've got more than 100 employees, it's only going to apply to employees that are not performing services for you. But that means you're paying them, right? So you've sent them home, but you're still paying them. Or that you could do that now, send people home and continue paying them. So that's what's meant by idle. They're not performing services, but they're still on your payroll. So the intention of the program is to support that situation if that's what you've done, right? So if you cannot operate because of the crisis, but you didn't want to let your employees go, and you decide to keep paying them, then the employee retention credit could apply there. If you've got fewer than 100 employees, you don't have the rule that they have to be idle, so that shouldn't be an issue.
Great.
There were quite a lot of questions, so I'm glad to see that.
Yeah, I've got one here. Can a sole proprietorship LLC, whose income is solely 1099, apply for the PPL benefit using their 1099 income from 2018 or 2019 tax return? The answer is yes. They want to make sure that small businesses apply. I think you've got the right idea. You would show your 1099 income. You probably have to show a Schedule C to show what your expenses for your business were, but what the net income or what would be your pay from that business, your net income, I believe that's what they'll be lending on. I think it's a straightforward analysis like that, and those are the key documents you'll need for sure.
Right. We also have a question here: which programs could be combined? I definitely want to hit that because I wanted to make that very clear to everybody. You can get either the Paycheck Protection Loan or the Employee Retention Credit. Cannot get both of those. Those do not go together. But that's the only rule we see here. So if you're an existing SBA borrower and you're going to receive the benefit in the form of the deferral and the 6 months principal and interest payment, that's not going to prevent you from taking advantage of any of the other programs. The EIDL, which is the Economic Injury Disaster Loan, that can be combined with the Payroll Protection Loan, provided the money is used in the proper way, meaning you cannot double dip. If you are getting an EIDL loan that is for payroll, you cannot also get a paycheck protection loan, right? So you can have an EIDL and a paycheck protection loan, but they have to be devoted to different things. If you've got an existing application that's pending for an EIDL, you're probably going to need to make sure you coordinate that, because if you're asking for funds for the same purpose, that's going to be a problem. It has to be devoted to different uses, right? So that's the catch on that. The programs can be combined, but you can't double dip for the same expenses.
What about temporary employees, Alex?
Temporary employees, there's no reason that the funds can't be used for temporary people. Number one, the statute just doesn't speak to temporary people at all, so you could certainly use it for that. Number two, it would be good for us to point out here that for the most part, the baseline of the Paycheck Protection Act loans is a 1-year look back for your monthly payroll. However, there are some special provisions for new businesses and for seasonal businesses. So you may be able to use a little bit more appropriate baseline. If you bring in temporary workers, for example, because you're seasonal, you may be able to customize the program a little bit better to your specific business. But other than that, temporary workers can be paid with this money.
And as a follow-up to the issue we were talking about a minute ago with U.S. subsidiaries of foreign companies, where the U.S. subsidiary is under 500 employees. Similarly, so I don't think there's any lack of clarity on that issue, right? That we're focused on the U.S. company for purposes of this. So similar issue, private equity-owned companies, where the portfolio of companies, if added up, would be greater than 500, but there's no indication to me, and you guys can comment on this too, that the employees of either the private equity fund or the other portfolio companies would be counted. Each portfolio company would be able to apply on its own, assuming that it's a separate legal entity.
I think that's exactly what I'd have to reread that section of the statute and satisfy myself that there's nothing on private equity, but maybe Alex, you can comment. I don't remember seeing the thrust of the language in the statute was to make sure everybody counts, like as an independent business. If you've got a PE with a bunch of different companies that it owns, they're not all rolled up into one. They want them treated separately so that they can, every American worker can get paid and remain employed. That's the spirit of this thing. So you've got it exactly
right. I don't remember anything on that issue, but I mean, this is obviously with some specific edge cases. It would be wise to get a little bit of legal advice before you jump, but I think for the most part, you're going to be fine.
Right. Here's a good question, which goes right to something I emphasized, and it's good to emphasize it again. The question is, must forgiven loan be incurred and paid in the 8 weeks, meaning that we must ensure that the expense is paid in that time period, else risk not getting forgiveness. I think that's exactly the way the statute reads. And I think it would be sort of a bureaucratic process at the end of this when there's, hundreds of thousands of these forgiveness applications. And you're going to have to show that the expense was incurred and paid in the 8 weeks. That's why I'm emphasizing, don't drag your feet on a bunch of April, obligations that came in at the end of March and then pay it at the end of April with the loan money here. You're going to have, I think the way this is going to work, the math, we've done it a few times for different clients. You're going to be spending this money pretty quickly with 8 weeks of payroll and the May 1 and June 1 obligations for rent and the other expenses that we noted, the utilities, health insurance premiums that come in monthly. And that same person posted, is interest on any secured loan forgiven or just interest on a loan for real property? Excellent question. Statute specifically says that it is interest on a loan that's secured by real or personal property. So it's both. As long as it's a secured loan that taken by the borrower and existed before February 15th, 2020, and was taken in the ordinary course of business, meaning just a normal loan, not something one-time special loan, then the interest payments that you make that are incurred and paid during the 8 weeks after you receive the money will be part of the forgiven loan amount.
Great. Well, I think that that covers our allotted time. I think we've covered most of the questions. So unfortunately, we didn't have time to get to some of the HR issues that were included in the presentation, but I think it's fair to say that everything Tony and Alex and a little bit of me covered on this webinar is way more timely than some of the HR issues that have been kicking around for a couple of weeks. But I would invite anybody who would like to hear about those HR issues, just send us an email and we can schedule a webinar to cover those items as well. Also, as I said at the beginning of the presentation, I'd like to invite anyone on the call to reach out with any questions that they have about what we discussed today or how it applies to their companies, and we'll do our best to help everybody through those issues. So, all right.
Yeah, and if anybody who posted a question we didn't get to, which again, we're just being respectful of everyone's time, but feel free to shoot any of us an email. We're happy to respond to it, talk to you about it. We've studied this thing. Our goal here is to share our, what we've taken away from reading this thing. We're happy to help anybody who contacts us.
Okay.
Well, let's just point out one of the last questions I'm seeing is whether we're going to make this presentation materials available to everybody. So I'd like to answer that by saying yes, we will. It's not a problem. If you want that, shoot us an email. We can respond to that, give you a copy of the presentation materials. And also kind of a fun note, I think. I see that maybe not, if we didn't get to every question, at least some of the members of our audience have answered one another's questions. So I think that's pretty cool. There's an ongoing discussion on the chat there. So I hope we caught most of it, if not all of it.
All right, everybody. With that, we'll close. Thank you again for spending time with us this afternoon, and we'll look forward to staying in touch and sticking together as we get through this crisis. Thanks very much.
Everyone stay safe.
Everybody.